Hello and welcome to the next episode of the Timberchase Financial Wealth Brief. Today we're going to talk about tax loss harvesting, SMAs or separately managed accounts, and direct indexing. At its core, tax loss harvesting is a tax management technique. When part of your taxable portfolio is down, you may be able to sell at a loss, reinvest promptly, and potentially use that loss to reduce taxes. Done well, it can improve your after-tax outcomes over time. Done poorly, it becomes an expensive and unintended drift into market timing. Tax loss harvesting is a two-step process. Many investors understand step one, sell at a loss to capture the tax loss. The sometimes forgotten step is step two, reinvest in a way that keeps the portfolio's intended risk level intact. If you sell an investment at a loss and do not replace it with something meaningfully similar, you did not just harvest a tax loss, you changed your portfolio risk level unintentionally. We sometimes see a version of this when an investor sells at a loss, sits in cash until things feel better, and plans to get back in later. That is not tax loss harvesting, that is market timing, and it can go poorly because recoveries, on a large scale or at the individual security level, don't tend to announce themselves in advance. A disciplined process keeps you invested. The objective is to capture the tax benefit without changing the portfolio. Tax loss harvesting does not create market returns. What tax loss harvesting can do is improve after-tax efficiency by generating losses that can typically be used to offset future capital gains and, if losses exceed gains, offset up to $3,000 per year of ordinary income. The value is often meaningful in volatile markets, but it is not guaranteed. It can depend on your tax bracket, your future gains, your time horizon, and how your plan integrates charitable giving and your estate plan. So what does a best practice approach look like? Our view is that the best version of tax loss harvesting has a few consistent characteristics. First is broad diversification. A portfolio that is diversified across multiple asset classes and parts of asset classes tends to create more natural winners and losers at any given time, which can create more harvesting opportunities without distorting the plan. Because returns are random and because asset classes perform differently in different economic conditions, being tax sensitive across all asset classes may get a better result. Harvesting inside of one asset class may provide some value, but, for example, U.S. large cap stocks tend to move together when there are other asset classes that may not be correlating at the same time. Number two is low friction. The less you give up in fees, trading costs, and complexity, the more of the potential benefit you keep. Number three, immediate reinvestment. The process should be designed to capture losses while maintaining comparable exposure, so you are not inadvertently taking a market bet by going to cash or changing the portfolio's risk profile. Number four, household coordination. We believe tax strategy tends to work better if it is managed across the household rather than inside isolated product silos. Number five, integration with charitable and estate planning. For many families, tax efficiency is not just harvesting losses, it is coordinating gains, gifting appreciated investments when appropriate, and aligning decisions with long-term intentions. It is possible, never promised, never guaranteed, for disciplined tax management plus charitable giving to materially reduce lifetime capital gains taxes and in some cases eliminate them altogether. This is the framework we think investors should use when evaluating any tax managed strategy. A common question regarding tax loss harvesting is, should I use a separately managed account or an SMA to handle tax loss harvesting for me? This is sometimes also called direct indexing. When someone is comparing a direct indexing SMA to other approaches, a simple question helps with the decision. Do I want part of my portfolio to be managed tax efficiently or all of it? The instinctive answer is all of it. We believe tax loss harvesting tends to be more effective when it is coordinated across multiple taxable positions, multiple asset classes, covering the household's overall allocation. If tax management is siloed inside a single sleeve, you may be improving one corner of the portfolio while missing opportunities elsewhere. It is important to remember when evaluating any product that markets are uncertain and return projections should be treated with skepticism. We sometimes see implied return expectations that may be a mirage. Where can direct indexing and SMAs make sense? Direct indexing through an SMA offers more individual positions that may lead to more surface area. In some situations, that can be beneficial. The question is whether the tool is the best tool to get the overall outcome that the investor seeks. Here are some trade-offs to understand before you buy an SMA wrapper. First, fees can consume the benefit. We have seen SMA management fees quoted as high as 1.5%, and at that level, it is possible for the fee to absorb much of the tax advantage, especially over a long holding period. Lower fee alternatives exist, sometimes closer to 0.5%. If an SMA is being used primarily for tax loss harvesting, the fee is not a footnote, it may be the main risk. Number two, the step two problem is harder with individual stocks. With broad market exposure, replacing exposure after harvesting can be relatively easier. With individual stocks, replacements can be less precise. Selling one company and buying a different company may not be the same exposure. Over time, this can create unintended drift in your portfolio. Number three, charitable gifting can be limited or impractical. Some charitably inclined families prefer donating appreciated investments rather than cash. In some SMA programs, donating specific appreciated positions is either not allowed or it becomes impractical. If charitable planning is part of your tax strategy, ask how this works before committing. Number four, step up in basis may reduce the value of an SMA for some families. If someone is later in life and expects to hold taxable assets until death, current law can provide a step up in cost basis for heirs. In that scenario, paying an ongoing fee purely for harvesting losses may have limited payoff. Tax law can change, so this should not be the only factor, but it belongs in the analysis. If you are considering an SMA or direct indexing proposal, ask some questions first. Was this pitched to me in context of my overall financial plan or as a standalone product? Is this designed to tax loss harvest one sleeve or coordinate across the full household portfolio? What is the all-in fee and what must be true for the tax benefit to exceed that fee? Is it possible to get the value of tax loss harvesting without paying this additional fee? Does the process reliably complete both steps, harvesting losses and maintaining intended risk exposure? Does it integrate cleanly with charitable giving and estate intentions? And am I relying on rosy return expectations that are not realistic? As always, take this as general information, not tax or financial planning advice. Tax rules are complex and personal, and you should coordinate what you do with your overall tax plan. If you are evaluating a direct indexing SMA and want a plain English view of whether it is likely to add value in your situation, give us a call. We can help you pressure test the fee, the constraints, and whether the approach is built to tax loss harvest a slice of your portfolio or influence your overall financial plan to your benefit. Thanks for watching.